The U.S. economy, it's been showed some signs of instability lately, and we're going to deep dive into some data, maybe through what we can learn. If you want to understand why, make sure to like and subscribe so you don't miss out. Okay, so the Atlanta Fed's GDPNow forecast predicts the economy could shrink by a significant 2.8% in the first quarter. To understand, what that means, it helps to think about the four main parts of GDP. So those are consumer spending, private sector investment, government spending, and net exports. And each of these is playing, a role in this decline. So let's take consumer spending. The Atlanta Fed, they estimate that year-on-year growth in consumer spending has dropped to almost zero. It's a huge change from the 2% growth we saw just last year. This slowdown in spending is reflected in surveys from the University of Michigan and the Conference Board, and they reveal a really steep decline in consumer confidence. And a big part of this decline is driven by these soaring inflation expectations, the highest we've seen since 1995. And the Conference Board's Expectations Index, which basically measures how optimistic people feel about the economy in the near future, has fallen below 80. That's a level that's historically associated with the recessions. But what's even more, worrying is that if you look closer at consumer spending, it reveals this growing disparity. Analysis by Moody's shows that a whopping 50% of all consumer spending is now coming from the wealthiest 10% of Americans. And this suggests that the bottom 90% are already, experiencing kind of a recession-like situation. Their spending power has been significantly reduced. This concentration of spending power in the hands of the wealthy is a big implication for the economy as a whole. It means that the stock market, which is typically seen as separate from the real economy, is now a critical indicator of economic health. And that's because the affluent, they hold a big portion of their wealth in stocks. So any downturn in the stock market can directly impact their spending habits, potentially triggering a broader recession. It's important to know that this economic fragility, isn't solely due to any one administration or policy. However, surveys consistently point to tariffs, or at least, the threat of them is a major factor behind dwindling confidence. This makes sense because tariffs can increase costs for businesses, which leads to higher prices for consumers. So coupled with these, rising inflation expectations, tariffs create a perfect storm of economic uncertainty. This uncertainty, it's been reflective in declining approval ratings for the current administration, especially when it comes to, how they're handling the economy. Despite, initially enjoying positive marks for their economic policies, their current approval ratings on this front are at an all-time low. And as if all of this, wasn't enough, we also have the looming issue of inflation. So after briefly dipping to 2.4% in September, year-on-year inflation has climbed back up to 3% in January. And the administration's tariffs, by driving up the cost of imported goods, are expected to make inflation even worse. This puts the Federal Reserve in a tough spot. They may be forced to either raise interest rates, which could slow down the economy even further, or delay these much needed rate cuts. And this pressure on the Fed might help to explain the recent criticisms directed at them, both from within the administration and from prominent business leaders. Finally, there's the elephant in the room, the national debt. The administration's promise of tax cuts without any serious plans to reduce spending has come back to haunt us, and national debt is ballooning. Despite initial hopes that they would find budget savings to offset the tax cuts, the reality is far from promising. The official figures show only meager savings, a drop in the bucket compared to the massive $7 trillion budget. To make matters worse, the recent Republican budget proposal, which has been endorsed by the administration, is projected to add a staggering $2 trillion to the deficit over the next decade. While the U.S. can still borrow money at relatively low rates, this is largely because investors see U.S. Treasury bonds as a safe haven in these uncertain economic times. This situation is simply not sustainable in the long run. U.S. can't keep borrowing indefinitely without facing serious consequences. It's probably too early to say for sure what the future holds to the U.S. economy, but the warning signs are there. They're flashing red. Declining GDP, plummeting consumer confidence, this stubborn inflation, and a ballooning national debt all paint a pretty worrisome picture. These factors, combined with these ongoing trade tensions and policy uncertainty, suggest that the American economy, once a symbol of strength and stability, is now teetering on the edge of a potential downturn. So if you found this deep dive informative, don't forget to hit that like button and subscribe for more insights into critical global issues. What do you think, what are your thoughts on the potential consequences of the economic trends? How do you think these challenges will affect businesses, investors, and, everyday Americans? Share your insights down in the comments below.